Oh, right. Today is Tuesday, June 7th, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight, so let's dive right into it. In focus. She's back. The insider trader, the queen of insider trading, Nancy Pelosi, is back. And then we have the inventory disaster from Target, which comes with more moronic calls by Jim Cramer. And lastly, word on the street. We start with the queen of insider trading, Nancy Pelosi, the most corrupt government official in history. Well, we now know why her husband, Mr. Pelosi, got caught in a DUI last week, because despite his financial knowledge that the Fed is tightening, the economy is falling apart, his wife Nancy convinced him, or shall we say ordered him, to buy the dip in the stock market. This time around, she told him to buy the dip in Apple and Microsoft, about $2 million worth of call options. Take a look.
Welcome back. House Speaker Nancy Pelosi back in the spotlight because of her stock trades. The lawmaker disclosed her husband, Paul Pelosi, purchased options to buy up between $750,000 and $1.5 million worth of Apple stock and up to $600,000 in Microsoft stock last month. The news coming just months after the speaker signaled that she may be willing to advance a bill to ban individual stock trading by lawmakers. She had previously shot down the idea, claiming it's unfair to exclude lawmakers from playing the market, but that was really disingenuous, Dagan, because nobody is telling her to not have access to the stock market. Like most of us who may have access to inside information, there are indexes to buy or exchange-traded funds or mutual funds rather than buying individual stocks. So she's disingenuous when she comes out with this idea that it's unfair that lawmakers shouldn't invest in the stock market. Your reaction?
And if you look at the official filing, the majority of these trades took place on May the 24th. Of course, we're talking about Apple and Microsoft, the two most important names in the NASDAQ. Well, guess what happened in May 24th? Here it is. The market bottomed and started to rally again. Excellent timing by the queen of insider trading once again. And folks, this is the kind of corruption that's just unheard of. This is the kind of corruption that makes third world countries look like civilized democracies. She's buying options. She's trading options. She did not buy an ETF or a mutual fund or even an individual stock. She's buying call options. How is that not insider trading? But the good news is inflation is surging out of control, which will force the Fed to tighten even more when it comes to the monetary policy. And that will lead to lower equities sooner or later. So assuming that the Pelosi's are going to hold till expiration, let's hope that they're going to hold a massive, massive bag. And of course, this will lead to more drinking and driving by Mr. Pelosi. And before we move on, since we're talking about Nancy, here is a revisit to Batshit Money by Kyle Dennigan.
You're back with me, Nancy Pelosi, just in time for the lightning round.
That was easy.
There should probably be a law against Congress people trading stocks, but we just haven't gotten around to it. Okay, let's get batshit. Hank from Toledo, you're on.
Booyah, Nancy.
Booyah.
I read your husband bought Google just before the antitrust bill vote. You guys made $5 million?
Mm-hmm.
So was that like luck? Or...
Yes, it was a miracle. Thank you, George Floyd. Okay, Mark from Illinois.
Booyah, Nancy.
Booyah.
Hey, should I hold on to my Tesla position before the EV bill passes?
Sell.
That was easy.
A little birdie told me I'll be voting the other way.
Now, let's move on to the disaster from Target that we got in the morning. And I don't know if you watched the video that I made after the earnings came out from Walmart and Target. And the CEO of Target was on CNBC that morning, and he was sweating bullets because he was watching his stock crashing in real time. Absolutely hilarious. But we knew the company was in trouble, and now we got the confirmation. Target warned profits would drop this year because it bought too many goods. It is the largest sign or latest sign of the sudden supply and demand mismatch at U.S. stores. Now, you might be stupid enough or perhaps maybe ignorant enough to go with Jim Cramer, who looked at this and assumed that this is peak inflation. Matter of fact, Cramer, Green Lights Tech Stocks, says Target's inventory woes suggest inflation is peaking. Now, a reminder, here's the same guy about a year ago. This is what he said about supply and demand, praising Jerome Powell. Take a listen.
Now, Jay Powell, on the other hand, believes we can handle all this inflation because over time it will gradually take care of itself. Plus, he thinks the cure, raising interest rates so the economy, might be worse than the disease. Powell wants us to get back to a tight labor market in order to help the downtrodden who haven't been able to benefit from the current boom. True. Man, oh man, am I ever with Powell. Speaking of the boom, as JP Morgan's Jamie Dimon explained at a conference today, booms are good. And that there's not necessarily too much of a good thing. We've yet to experience classic demand destruction where prices get too high to sell for anybody to sell things. Oh, it could happen. I don't see it happening now. Right now, though, even though I can totally see and feel inflation from all sides, I'm sticking with Jay Powell as my quarterback. Sooner or later, the plastic plants will come back online. The semi companies will have more capacity. The president will make trade deals to bring in more raw materials, and things will solve themselves.
Now, I'm going to explain to you why Jim Cramer is wrong by the end of the segment, but he says inflation is peaking. Retailers such as Target are now forced to lower prices because they have an oversupply of inventories. But you got Janet Yellen coming out today. Remember, transitory Yellen? Well, she came out today and she said she warns that the U.S. is likely facing a prolonged period of elevated inflation that will last. Meanwhile, last year she was going transitory. And folks, at this point, the only thing I want to hear from Janet Yellen is, ladies and gentlemen, I resign, effective immediately. That's the only thing I want to hear from Janet Yellen at this point. She got it wrong from the get-go. And it's not just Janet Yellen, by the way, who says inflation is going to persist. Listen to one of the top criminal organizations in this country, BlackRock. Well, the CEO says he expects inflation to remain elevated for several years. We went from transitory to infinity and beyond. Even the World Bank came out today slashing global growth forecast to 2.9%. And give them a few more weeks, they're going to slash it down to 0. But they also warned of 1970s style stagflation. Wow, they finally came around. Meanwhile, the guy you're listening to right now, who barely finished college, by the way, and got C's in economics classes, but I called stagflation more than a year ago. I wonder why. You know why? Because I looked at the facts. I have no political agendas. I have no ties or obedience to the oligarchs. Look at the facts. You put 2 and 2 together. We're going to have stagflation. Now we have stagflation. And the World Bank admits that we're going to have a 1970s stagflation. If not, we're already in one. And speaking of the 1970s, now everybody assumes that the inflation in the 1970s was the worst, and we cannot match that kind of inflation. But according to Larry Summers, when you adjust the CPI formula that we use today, and you apply it to the inflation in the 1970s, the CPI at the peak of that inflation period, around June 1980, the core CPI was not 13.6. If you apply the current CPI, that inflation was actually 9.1%. And some of us remember how destructive that inflation was. The old-timers, they remember all of that. We are now at 8.5%, and that's the Fugazi number, by the way, which means that we are now at one of the worst crises of inflation ever in this country's history. And if this continues, we will make the 1970s look like a little baby because we're led by a bunch of incompetent fools who cannot realize that inflation is a monetary phenomenon. It has always been this way, and it's not going to go away without a response from the monetary policy. Now, when it comes to Target, we knew this was going to happen all along. We got the warning last month that retailers are having ballooning inventories. Not just Target, but Gap, Walmart, all of them made the same mistake. All of them are facing the change in consumer behavior forced upon by inflation. We'll talk about that by the end of the segment, but it is not just Target. We heard it last week from GameStop. GameStop was increasing their inventories in an insane way, assuming that the spike in demand would last forever. And now they're having the same problem as with Target, to the point where GameStop employees are actually quitting their jobs, posting signs at the door. They close the shop, they post these signs saying, hey, customer, go shop somewhere else. This is garbage. This is trash. We're overworked. We have an insane amount of inventories. And the supervisors, the district managers, are now assigning quotas for the employees. And if they cannot fulfill the quotas, they get punished and harassed. Well, where is the demand? You oversupplied the inventory, and the demand is nowhere to be found because nobody's going to spend $30, $40 on a video game when you're spending $100 to fill your gas at the pump. And we're seeing this divide in consumer spending in this country, just like with everything else. It is a great country if you're rich, and it is absolutely horrible if you're poor and middle class. because we've turned this country from the classic American model of capitalism where everybody got a shot, the American dream is still alive, even if you're not rich, you're living comfortably. We changed all of that and we made the country into an oligarchy where the rich owns everything while the rest of us are financially enslaved, living paycheck to paycheck. This is what America looks like right now. Thank you to the genius, corrupt politicians, most importantly, the criminals at the Federal Reserve. Now we're seeing this divide in inflation. The wealthy, oh, they're splurging, no problem. They got all the cash in the world, and it doesn't matter if they're paying 10, 20, 50 bucks at the pump per gallon. It doesn't matter. But the poor, the middle class, they're getting absolutely crushed. They have to pull back spending. And this is an important thing to keep in mind to understand what happened to Target, what happened to Ross, what's happening to Walmart, and many others. They have to pull back that spending and reallocate that spending in the gas pump, in the grocery store, paying for rents and utilities, aka essentials, because this inflation in these items, the essentials, is moving significantly higher by the day. Gas out of control, over $7 a gallon here in California. Rents surging out of control. Nobody's doing anything about it because the corporate landlords, they own all of your government. Your local government, the cities, the municipalities, they're all owned by these corporate landlords.
They got you by the balls.
And they continue to scoop these single-family homes in the suburbs and turning them into rental units. By doing so, they're taking inventory, much-needed inventory for families, pushing all of these prices higher. And now all of us have to succumb to renting from these monsters, these corporate landlords. The American dream is dead. The problem with the consumer right now is inflation. Inflation is eating away their spending power. And it starts by eating away household savings. That is step number one. Step number two, here comes swiping those credit cards up and down, up and down, up and down to cope with this inflation. Step number three, when you max your credit card, you go with the buy now, pay later, or never. But you cannot run forever. At some point, this inflation is going to start to cause tragedies when the consumer cannot cope anymore. They exhausted their savings, they maxed the credit cards, and now they owe a massive amount of debt. What happens when interest rates start to move higher because inflation is persisting and we start to see job losses in the economy? That is the point when you start to see foreclosures of homes, used cars being dumped because they have to raise cash, they don't have an income anymore. That would be a tragedy in the beginning of a recession. The Big Short Michael Burry is warning that the U.S. economy is in borrowed time and consumers will blow through their savings in a matter of months. We looked at this before. Look at consumer savings. It is now at the lowest level since 2008. I wonder what happened back then. When Jim Cramer says that inflation is peaking and everything is going to go back to normal and even better than before, here's the reality. More than 8 in 10 Americans hate this economy. That is the highest number since the poll began. The point from all of this is to understand what's going on in Target and the disaster that we got today. You have to understand the shift in consumer sentiment and consumer spending behavior forced upon by inflation. For example, Gen Z and millennials are having the hardest time paying off their cars, and it speaks to their economic pain. The Cox Automotive Moody's Analytics Vehicle Affordability Index, which measures the ability of a household making the median income to afford an average-priced car, reported in May that it now takes a record 40.6 weeks to buy a car. Meaning, in order to afford the regular car, nothing fancy, you have to save up 40.6 weeks worth of earnings if you're just earning the median income to afford a car, meaning you have to work for at least 10 months to afford a car. That is assuming, of course, that you're not spending anything at all, not in rent, not in food, not in utilities. This is insane, folks. This has gotten out of control. New vehicle affordability continues to be much worse now than a year ago when prices were notably lower and incentives were higher. April's affordability index number represents an 18% increase from last year's, according to the company. And listen to this because it ties up with last night's video, the EV paradox, the EV lunacy. The average car now costs $46,526. Unbelievable. Who can afford that, by the way? When the average car costs over $46,000. And this is the most alarming part. Gen Z borrowers had an overall delinquency rate of 2.21% in the first quarter of 2022, with millennials close behind at 2.14%. Now, you might say, hey, 2.21%, that is insignificant, but this is up from 1.75% and 1.66% respectively. Those are spikes of 26% and 29%. Now, what happens if you're behind in your car loan, if you're getting squeezed by the cost of living? Are you really going to go ahead and spend on Target? Of course not. So does that mean that this is peak inflation? Of course not, because the change in consumer spending, leaving Target oversupplied, was done because of inflation moving higher in other areas of spending, specifically necessities for the consumer. This is getting out of control to the point where even Fed Bullard from St. Louis says that the Fed is in danger of losing control of public expectations of future inflation. Why? Because we know that the Fed is incompetent. This is the same Fed that said inflation is transitory. You want to restore the public's trust in the Federal Reserve, get rid of Jerome Powell effective immediately, and get rid of Janet Yellen and the rest of these fools immediately. And look at this. This is the booming economy that Joe Biden is proud of. The Atlanta Fed is now lowering the GDP forecast from about 2%, matter of fact, above 2% from just a few weeks ago, to now 0.9%. Uh-oh. Things are falling apart here, folks. And even the Fed knows that. So in summary, is the news that we got today from Target that they're oversupplied by inventories and they're going to have to cut prices, is that an indicator that inflation is peaking? The short answer is no. Because, number one, when it comes to Target and many other retailers, they made the same mistake. Their inventory strategy was pinned to a superficial spike in demand induced by the stimmies. They assumed that the stimmies are going to last forever, and they ordered more and more and more supplies to cope with that demand, that spike in demand. Here's the problem. It took a while for that supply to hit the shelves. By that time, here comes number two, forced redirection of consumer spending by inflation. So you might have ordered something from Target last year. It's here now, but you cannot afford it anyways. Why? Because you're now spending more at the gas pump. You're spending more on your rent, on utilities, at the grocery store. So all of a sudden, that item that you bought from Target last year or you ordered from Target last year becomes unnecessary and unaffordable, which leads us to number three, demand destruction via higher prices. Now you might say, hey Maverick, isn't this a good sign that inflation is peaking? Prices went too high too fast. The consumer cannot afford them, which means that they have to take these prices down to meet the demand. Not really. You're wrong in your assumption, because you have to keep in mind the input cost for Target. Their costs are moving higher by the day, specifically in transportation costs. Look at diesel prices, for example, reaching all-time highs. If they cannot pass that extra cost all the way down to the end consumer, and they have to get rid of inventories by lowering prices, well, guess what? Their profit margins are going to get crushed immediately. And the end result of all of that is they have to get rid of employees. And this is exactly what we talked about when I said stagflation will do the job. It's just going to do the job in a slower and painful way. And there is no guarantee by the end of it that inflation is going to go down. Versus if the Fed takes charge now by increasing interest rates dramatically, as they have to do, we will see unemployment moving higher fast, but we will see inflation moving down fast. And the Fed will have the ammo to rebuild the economy again and recover the loss in employment. If they wait for stagflation to do the job, this is what's going to happen. You're going to see this story replicated across many other retailers. Now that the consumer is shifting spending from goods to services and essentials. By the way, services, that's the next shoe to drop. After the summer, spending on services will drop like a rock because inflation will move higher, and now the consumer has to allocate more spending to necessities, gas, rents, utilities, groceries, and the economy is going to start to fall apart. That becomes stagflation, and the next step would be a recession. But hey, if you feel that this is all FUD and I'm being a perma bear, yada, 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 you don't have to listen to me. You can listen to the perma pumpers from Goldman Sachs who say that the U.S. economy will slow down to a crawl as the Fed hikes rates, but will dodge a recession. A miracle will happen. Or the perma pumpers at JP Morgan, the laundromat, where the chief economist says there is no reason to be worried about U.S. recession, with the private sector in a remarkable shape. Did you listen to your boss last week, Mr. Hurricane? And folks, yes, the economy right now is still holding, but it's going to dip into a recession. And your spot-on indicator, whether we're in a recession or not, would be this. If folks start canceling their OnlyFans memberships. OnlyFans says it is not seeing a Netflix-like slowdown in subscribers despite rising inflation, because you cannot afford Netflix for now, paying $10 a month to watch movies and TV shows, but you can afford $25 a month for some girl online to send you dirty pictures of her feet. That's important. That's essential. So when you cut on that and you stop the creepy habits, that is a spot-on indicator that we are indeed in a recession. Now, let's move on to a segment we call Word on the Street. Because you might have noticed that yes, Target was down over 8% pre-market, but the stock market recovered and finished at the highs of the day. Stocks trimmed losses. The Nasdaq turns positive. Nancy Pelosi bought the dip. Who cares about the recession or Target? Who cares about any of that? If Nancy buys, I'm buying too. And it's not just Nancy buying. The insider stock purchases are at the highest level in more than 2 years, potentially signaling a market bottom. This is, of course, according to the experts. Experts such as Tom Lee from Neptune, who says that investors should buy mega-cap tech stocks as Nasdaq valuations plunge to a depth not seen since the end of the dot-com bubble. I'd rather buy Mega Pint, not mega-cap tech stocks. But anyways, you have another strategist with a spot-on record who sees stocks surging 15 to 25% from the May low, aka when Nancy bought the dip. And even the perma bears at Bank of America say that the S&P 500 has room to rally 7% before resuming its longer-term downtrend ahead of more Fed tightening. So what does that mean? A bear market rally? Anyways, even investor sentiment is improving dramatically. Matter of fact, the crowd got increasingly bullish last week as the S&P 500 turned higher. Similar scenario played out with counter-trend rally in March, but that move higher ended up being short-lived. In other words, we got a bear market rally, enjoy it while it lasts. Because here's the problem. Yes, valuations went down, but they're not down by enough. They're not down to normal levels, aka the mean. Remember, Jeremy Grantham says the reversion to the mean? Well, we're not even close to the mean. We have a long way to go to the downside before we get to the mean. Because when you look at the NASDAQ 100 forward PE ratios relative to the small caps in the S&P 600s, this is the highest valuation since 2005. So we have a long way to go here for the NASDAQ, for the mega caps to go down before we say, okay, we have enough of a correction here. Valuations are cheap again. Even Katie Stockton, remember that one? She now says the market rally will not last and this summer will be rough as the S&P 500 could go as low as 3,200. And the reason is we need the retail crowd. If the stock market is about to recover or move higher again, we need the retail crowds, the mom and pops, the apes, the donkeys, the rest of the zoo to participate. But they're not. Why? Because they're dead. They're gone. The meme stock revolution is over. Matter of fact, Goldman Sachs says the U.S. retail investor have sold most of what they bought over the last 2 years. And look at this. The new generation of investors, the retail crowd, aka the apes, they bought the dip after the crash of the thing back in 2020. They enjoyed a mania ride to the upside, to the moon. And then the moon came and they went downhill, and now they're dead. They're gone. Does that mean the retail investor is dead? Of course not. Look at this channel, for example. We still got mom and pops. We still got retail crowd. And the channel is growing by the day. Even the apes are coming around and saying, okay, let's learn how to do this for real. And there is a reason, folks. I did not cater to the apes, to the cryptomaniacs. Even though if I did back then, at this point, this channel would have over 100,000 subscribers easily. But I'm a long-term motherfucker. Because I knew how this is going to end. And had I catered to the apes and the GameStop meme stalkers, whatever the hell they are, yes, I would have enjoyed massive spike in viewership. But then after these stocks crashed, after the apes are gone, look at all of these channels. The AMC pumpers, the Palantir pumpers, they're all dead now. But this channel continues to grow. Why? Because we have legitimate retail investors, legitimate mom and pops. They've been in the game before the mania, the mother of all bubbles, which started in 2020 after the cocaine operation by the Fed. They've been before that. They've been here before that. And they're still alive. Why? Because they're disciplined, they're legitimate retail mom and pops investors. But don't feel bad if you're an ape and you're down and you lost it all. Don't feel bad because even the hedgies are feeling the pain. Remember Tiger Global, which was the top performing hedge fund in the last 2 years? Well, here it is. Hedge fund giant Tiger Global has reportedly lost 52% this year as tech losses accelerated in May. But rest assured, the SEC got you back. The stock market might be a jungle, but the SEC is finally waking up from the coma. But don't get too excited because here's the catch. The SEC is set to reveal proposals to transform the U.S. stock market, such as by routing retail stock orders to auctions. Are you kidding me? This is what Gary Gensler does when he wakes up from the coma. His brightest idea is auctions, which is going to be another racket for the Wall Streeters. See, to solve the pay-for-order flow, which is a criminal behavior, by the way, his brightest idea now is auctions. By the same criminals, by the way. Unbelievable. You know what, Gary Gensler? You might as well go back to the coma. Thanks a lot, buddy. Thanks for nothing. And with that, folks, let's move on to cover the stock market activities today. We start with the performance of indices, and here we go. The Dow Industrial Average closing in the green by 264.36 points, or a gain of 0.80%. The Nasdaq in the green by 113.86 points, or a gain of 0.94%. The S&P 500 also in the green by 39.25 points, or a gain of 0.95%. It was a comeback day, initially a gap down in the morning, and then buying all the way till the end of the day. This is bullish behavior. Is it going to last or not? We'll talk in the charts analysis. But here it is. The sector's performance today, led by number 1, capturing the gold medal, energy. Number 2 for the silver, healthcare. Number 3 for the bronze, REITs. We're not going to shame any sector of the market today because all of them managed to close in the green. What about the advanced decline ratios? For the NYSE, 69% advancing versus 27% declining. The Nasdaq, 61% advancing versus 34% declining. Commodities, what's going on here? Crude, steady Eddie, moving higher. We're at almost 120 for each, the WTI and Brent, and both of them managed to score gains of over 1% today. Yet we have declines for gasoline. RBOB was down by almost 1% today. Likewise, heating oil was down by almost 1%, while we have natural gas muted, flat for the day after a massive pop yesterday. Now, since we're talking about gas and oil, here's your Stagflation update, morons. Sticking it to Putin, bruh. Gas prices are surging again to record highs, but the driver is refineries, not oil prices. So we have a shortage in refineries, and this is the reason behind the insane prices at the pump. Because folks might look at the futures, the WTI, and say, wait a minute here, why are prices at the pump making all-time highs when the WTI has yet to make a higher high since last March? This has to be price gouging, right? Or it has to be a leading indicator that crude futures will move higher and make higher highs. Not really. The driver for now is refineries. We're short in refineries, the demand is still high, and therefore you're seeing gasoline prices moving higher, now to all-time highs. And remember the let's boycott Russian oil, let's stick it to Putin, bruh. Well, here's sticking it to Putin. In theory, on paper, we banned Russian oil from ever arriving here in the United States. But since we're short in refineries, thanks to the greenies and the lunacy of the green agenda, we're now ending up having to buy oil from India because that is the only country with the refining capacity. Guess where India is buying oil from? Yep, Russia. And then they refine that Russian oil in India, and then they ship it all the way to the United States. That'll show Putin how it's done, right? We're going to stick it to him. We're going to show him how it's done. Meanwhile, you're paying $4.9 a gallon at the pump right now. Soon enough, it's going to be $5 in no time. In the meantime, while you're sticking it to Putin by paying $5 a gallon at the pump, by the way, $8 at the pump here in California, the value of Russia's sovereign wealth fund has rebounded to pre-war levels as petro-cash flows in. It seems that everything that our genius politicians are doing right now to quote-unquote punish Russia is actually ending up backfiring, hurting the U.S. economy and consumers while making Russia great again. Wow. Back to the futures. What about softs? We have a down day for sugar, losing about 3% today. Likewise, we have a down day for coffee, losing a little over 2% today, while we have modest declines under 1% for cocoa, cotton, and lumber futures. The winner in softs today was OJ, scoring gains of a little over 1 3/4%. What about metals? The dollar was muted today, went up, then it went down, and precious metals like the action. Gold was up, silver was up, copper up slightly, but we have a down day for both platinum and palladium, both losing over 1% today. Muted action for meats, be it in the green, led by live cattle futures, and then we have modest gains for both feeder cattle futures and lean hogs. What about grains? We're seeing gains led by soybean meal gaining a little over 2.5% today. Then we have corn scoring gains of about 2%. Soybeans also in the green by about 2%. We have some modest gains for soybean oil and rough rice futures. On the other hand, we got declines for wheat. Wheat giving up some of the gains from yesterday's session, now losing a little over 1.5%. Likewise, canola futures down by almost 1%. And then we have modest declines for oats. And when it comes to wheat, folks, perhaps the reason behind the dip in wheat today, we continue to ask the question, if the global economy is short wheat, specifically Russian and Ukrainian wheat, due to the war and the sanctions, then what about North America? Canada and the U.S.? Well, that's a no-go because farmers are not planting wheat due to the shortage of fertilizers. What about India and China? China's not going to export wheat, and India says now they're going to be short wheat. But now we have the answer, and the answer is coming from Australia, down under, because Australian wheat, the crop that we're seeing right now for this year, will be the fourth on record. Is it going to be enough to cover the shortage? Of course not, but it is good news at least for now. When you look at the Australian economy all in all, there is a reason why this channel has been bullish the Australian economy, but most importantly Australian stocks, because look at the contrast between the EWA, the Australian ETF, versus the SPX, the S&P 500. Year to date, the EWA, the Australian ETF, is flat, while the SPX, the S&P 500, is down, about 13%. I'll take flat. Flat is good for now. And when you think about the Australian economy, when we talk about lithium prices going out of control, when we talk about coal prices going out of control, when we talk about wheat prices surging out of whack, all of these commodities are produced in Australia. So this particular economy is faring a lot better than the US and European economies. Moving on to the big casino, the options market, what's going on here? The hottest table by far remains the newest table, Amazon, at around 1.2 million contracts traded today. About 60% of those were calls. And at number 2, Apple, with around 835,000 contracts, about 53% of those were calls. And at number 3, Tesla, the souffle, at around 450,000 contracts traded for the name today. About 50% of those were calls. The volume is still down, and we're not seeing call options buying. We're not seeing the ratios improving, and therefore the equities market is struggling to move higher. It wants to pop higher. It wants that leg higher to happen, but it's not happening, at least for now, because we're not seeing call options buying, at least in the mega cap stocks. Here's the unusual activities that took place in the options market today. We start with the ticker KWEB, KWEB, for the Chinese technology ETF. We have the reopening of Shanghai, Beijing. All of this is good. Tailwinds for the KWEB, but who knows if the recovery is going to be sustainable or not. But for now, somebody's betting for more gains to come for the KWEB by buying the 37 calls for the expiration date, July 15th, with expectations that the name could move higher by more than 15.5% by then. They paid around 75 cents apiece to enter this trade, all in all spending around $4 million. What about the XOP, the ETF for oil and gas? Somebody's buying calls, betting for more gains to come, big gains, I might add, by buying the 200 calls for the expiration date, July 15th, with expectations the name could move higher by more than 18% by then. They paid around $1.20 apiece to enter this trade, all in all spending around $700,000. What about the ticker UBER, Uber? They're buying calls here, betting for gains to come. In this case, the $30 calls for the expiration date, August 19th, with expectations that the name could move higher by more than 18.5% by then. They paid about $1.25 apiece to enter this trade, all in all spending about $675,000. And then we have the ticker UPST for Upstart Holding. In this case, they're buying puts, the 43 puts for the expiration date, June 10th, meaning this upcoming Friday, with expectations that the name could move down by more than 5.5% by then. They paid around $1.60 apiece to enter this trade, all in all spending around $800,000. And lastly, what about the ticker CVNA, Carvana? They're buying calls, betting for a rebound, in this case buying the 27 calls for the expiration date, June 17th, with expectations that the name could move higher by more than 6% by then. They paid around $1.80 apiece to enter this trade, all in all spending around $900,000. Now, if we have a wholesome rebound in the stock market, beaten down names with high beta such as Carvana will rebound significantly higher. So I'm making a list of these names, looking at the charts, the oversold charts with the potential of big pops, and I'm watching. If I see enough signs, good signs, that we're going to see a pop, I'm going to buy call options and Carvana is one of those names in my list. Moving on to the heat map analysis, what's going on here? Green across the board, led by energy, but the big caps, technology also performed with exception of Amazon. Amazon is down due to the bad news from Target. The bet is that Amazon will suffer from the same problem. All of them assumed that the spike in consumer demand by stimmies is going to last for a long time, which led to oversupply now in inventories. By the time these inventories hit the warehouses, well, guess what? The consumer demand shifted to services and essentials due to inflation. We're not seeing a specific theme here in the heat map, but we're seeing some weakness in utilities, for example, in the agricultural names, Nutrin, Mosaic, the names that were spiking higher, the consumer staples names due to Target, of course. Is this good enough of a sign that we're seeing the participants moving or rotating some money out of the agricultural stocks, out of defensives, all the way to software, technology? Not really. We have to see consistency here. And for now, we're only seeing a day or two of this kind of action, and then we go back to buying agricultural stocks, energy, and the inflationary names. We have yet to have a conclusion here, and the bet is we're not going to have this conclusion until the CPI comes out on Friday. So here is some corporate news for you. We start with TSM, Taiwan Semiconductor, because this name will become highly important in the next few months, because it will be a bargaining chip if we see tensions between the US and China heating up regarding Taiwan. And perhaps the Chinese, by looking at the Russian example, learned a thing or two, and the thinking goes, what if China decides to strike first by seizing TSM? Because all of this war with Taiwan is going to be about chips. What if China seizes Taiwan Semiconductor right away, taking that bargaining chip out of the table before the US even realize what's going on? It could happen, and if it does, the stock will crash like you've never seen before. And since we're talking about Target, well, guess what? Kohl's is probably facing the same problem, but that is not deterring all of these offers to buy Kohl's. Now we're hearing that the company that owns Vitamin Shoppe is in talks to buy Kohl's. And I thought the Vitamin Shoppe is bankrupt. How the hell can they afford to buy Kohl's? Anyways, we also have Reverend Elon, who's taking a shot at Google this time around. And all of you who say, why don't you praise Elon Musk once in a while? Here it is. I'm praising Reverend Elon Musk right now. Matter of fact, I'll give him a kiss if he was here. Because Elon Musk says YouTube seems to be non-stop scam ads. Amen. Look at the comment section. All of these crypto scammers using my profile picture and then trying to get you in to contact them in WhatsApp. How come YouTube cannot control that kind of scams? How come when I swear or when I use a video clip from a movie for 4 seconds or a piece of music for 5 seconds, my video gets taken down. My video gets demonetized. But they cannot do anything about what's going on here. The scammers, the fraud, and this is what happens when you let the algos do everything. They end up censoring content creators while allowing actual fraud, actual misinformation go rampant in the platform. But is Reverend Elon going to do anything about it? Of course not. He can go with Peter Thiel and start another YouTube and crush these assholes right away, take them out of business. But no, he will not do that, of course. Moving on to the heat map for the ETFs. Green across the board for the most part. We're seeing some weakness in commodities, evident by the underperformance of Brazil in international markets, the EWZ, while we're seeing Chinese equities moving higher again. The majority of the pain in commodities is not coming from oil or gas or even metals. For now, the majority of the pain in commodities is coming from lumber, and some fertilizers went down, and chemicals. But that's about it, because even uranium is moving higher today, big time, almost 6% for the URA, because the Biden administration is now pushing lawmakers to support $4.3 billion plan to buy enriched uranium from domestic producers, not from Russia. Now, when it comes to growth versus value, both performing neck to neck, so there is no clear winner here. When it comes to the ETFs, energy leading again, the XOP, XLE, OIH, all outperforming. We're seeing a rebound in biotech, XBI, a massive rebound of almost 5%. That is an indicator of perhaps some short covering happening. All in all, everything I'm seeing here is positive, indicating for more gains to come in the equities market. But the charts will cover the story from a different angle. So let's do that and move to the charts analysis. We start with SPY, the S&P 500, a 30-minute chart. What's going on here? We got a gap down in the morning, so the bear flag played out this time around, and it sucked a lot of bears, by the way. A lot of these, shoot you load right away kind of bears. Yes, the support of 410 got broken, but I've been warning, don't short right now. You're gonna get trapped. Wait for more support lines to be broken, in this case 405, before you start shorting. Because what happened, the dip was bought right away, the SPY went down, it retested 410 and then bounced higher, only to close the day at the highs, which happens to be exactly at the resistance of 416. So, all in all, is there any significant update in this chart? Of course not. It remains within range. The support 410, the resistance 416. But is the action that we got today of buying the dip right away, of retesting 410 and then rebounding and closing at the highs of the day, is this action bullish or bearish? The answer is it is bullish. Now, what about the daily chart for the continuous contract for the SPY? Again, no update here. The support of 4100 was briefly violated, but it is not a big deal because the chart did not close the day below 4100. So for now, and even if it does, by the way, we're not going to be too excited about shorting right now until we see, let's say, 3960 lost to support. You can short if 4100 is lost to support, but your target is going to be 3960, and you're going to watch for any rebounds that could happen in between. Because for now, assuming 4100 is intact as support, for now the pattern is a bull flag pattern. When we look at the volume went higher on a buying day. That is bullish, not bearish. The MACD indicator, the RSI, all still positive. Yes, they're plateauing, they're consolidating, but they remain positive. The SPX, the cash index, similar story here from a daily chart perspective. It briefly lost 4,114.65 for support, but it closed above it at the highs of the day. The pattern remains a bull flag. The volume moved higher on a buying day. All of these are good signs for the SPX. We're not going to become bearish until the gap is closed of 4,057.85 and the chart fails to rebound. Better yet, for me at least, personally, losing 4,000 of support. Here's the Qs, the NASDAQ 30 minutes chart. Again, we got the gap down, and then the chart closed at the highs of the day, yet within range. We got a defined support and a defined resistance. No update here at all. But is the behavior of buying the dip right away aggressively, closing at the highs of the day, is this behavior bullish or bearish? The answer is clear. It is bullish. Now we're waiting for the follow-up. Are we going to see a follow-up in tomorrow's session, for example, or will market participants be deterred by the upcoming CPI? Here's the daily chart for the continuous contract for the Qs, the NASDAQ. The pattern remains bullish, a bull flag consolidation, the resistance at 12,766, the support at 12,207. Nothing changed here, folks. The volume went higher slightly on a buying day. The momentum indicators remain positive. Nothing to see here. Moving on to the Russell 2000, the IWM, small caps. What's going on here from a 30 minutes perspective? We got the gap down. The dip buyers showed up right away. The chart got 118 as support. Notice that it was retested. 118 was retested. It produced a bounce, and the chart closed at the highs of the day. In my book, this is bullish behavior, not bearish, because if it was bearish, the chart would have failed the retest of 188 as support, but it did not. It caught that support, and it rebounded higher, and it closed at the highs of the day. It cannot convince me one way or the other that this is bearish. A reversal has to happen. The chart has to lose 188 as support before we start talking about shorting the IWM once again. The Dixie, the dollar index, what's going on here? It went higher and then closed at the lows of the day. The opposite picture with the equities market, the Qs, the SPY. The dollar is critically important because if it pops higher and it recaptures 103 as support, the equities market is going to stall. The bounce will stall, and that is the best case scenario, of course. We could see a reversal, changing course. But for now, all in all, this pattern remains a bear flag pattern unless 103 is recaptured as support. If this continues, we will see another leg down in the US dollar, and this will be welcome news by the Qs, the SPY, the Dow Jones, so keep your eye on the Dixie. Here's gold, no update at all. It continues to hold on at 1,840. This is the same support of the three amigos, so we know this is strong support. The moment gold loses that support, then you cannot continue to be bullish because this is a strong support. This is a reliable support. It has been retested over and over and over again. If it doesn't hold, then we have lower lows to come for gold. Here's the 4 hours chart for crude, Brent. The chart maintains a bullish pattern for now, but once the support of 118 is lost, then the bullish pattern goes out of the window. But for now, if the bullish pattern continues, meaning keeping 118 as support, the assumption is we're going to see a shoot up higher in a retest of 124. Here's the US 10-year yield, the daily chart. We got a down down day. Now, a lot of folks are attributing this to what came out of Target, that it could be peak inflation. Watch out here. This could be a false signal, because if the market does the reflection and looks at commodities, crude moving higher, natural gas moving higher, grains moving higher, and says, you know what? This could be a problem regarding inventory management for Target, but it also could be an indicator that inflation is shifting consumer behavior, meaning inflation is moving higher, not peaking. If the market comes up to this conclusion, we will see the 10-year yield moving higher, and that would be bad news for the NASDAQ. And bear in mind, we have the auction tomorrow. That would be critically important. What about the TLT, a weekly chart? Is the ABC pattern alive? Yes, and it is holding for now. Here's the ABC, could happen. Once you lose the previous lows, it's out of the window. Here's the VIX from a 4-hour chart. What's going on here? The chart broke the support of 24.29. This is a bad development for the VIX and good news for the SPY, but we have yet to have a confirmation. Traps happen all the time. Without a confirmation, who's to say that we're going to see another turnaround? 180 in the VIX. It recaptures 24.29 as support, and it shoots up higher from that point on. We have to see a confirmation. We have to see the SPY recapturing support at 416 before we make any assumptions. Here's the VXN, the VIX for the NASDAQ, again, 4 hours perspective. We're not seeing a confirmation that the Qs is done with the rebound here. It is running out of energy to produce the next leg higher. If that was the case, then we would have seen the VXN popping higher. We would have seen green impressions in the histogram of the VXN from a 4 hours perspective. That would be the confirmation, the VXN going higher and the Qs going down. We're not seeing any of that for now. So the assumption remains VXN going down, Qs should move higher. Apple, a daily chart, what's going on here? It continues to hold on at the support of 145. The resistance is 150. And it maintains a reverse head and shoulder formation. For now, the assumption is Apple should move higher. We have no reversal signal whatsoever, folks. Similarly, we have Tesla, 30 minutes perspective here. Is there any significant update? No, because 700 remains intact as support. Once that is lost as support, then we're talking the bears are going to short and down we go. But for now, this consolidation is indecisive. It is neutral because it is giving the buyers the opportunity to hop in and move this chart higher to close the gap. If they choose not to show up, then the bears, the sellers will, and we will see Tesla breaking 700 and moving down. What about BTC, tulips? What's going on here? It was ugly overnight due to the rumors of the regulations by the geniuses in DC. What do they know about cryptos? But then, as the equities market recovered, so did Bitcoin, and it closed at the highs of the day, maintaining 30,000 as support. Is this behavior bullish or bearish? It is bullish, but you're not going to feel safe to buy until we see 32,384 broken as resistance. And lastly, the viewer asks, why didn't you cover AMC, Mav? Question mark. It is about to squeeze. Well, here's an hourly chart for you. We're seeing a pattern of higher lows and higher highs. This is positive, but we need to see the chart above 14 again. Absent of that, the weakness could resume anytime. And the squeeze will only happen, by the way, if we get news that somebody's going to acquire AMC. The only viable buyer is Amazon. Now, AMC is trading at around, let's say, $6 billion. That is pocket change for Amazon. But will Amazon wait till AMC becomes cheaper to buy? Will Amazon buy right now? Who knows? But the only hope the apes have for now is for a larger company, in this case Amazon, buying the company AMC. If that happens, then you will see a squeeze. With that, let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? I'm watching the MBA mortgage applications. This will be important for the housing market. And then we have wholesale inventories. This is critically important after what we got from Target today. And lastly, the 10-year auction. That will also be critically important. Now, with that, folks, we're done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.
When I say something will happen, that thing